thanks for joining us. Undoubtedly, you're all flat out managing your businesses and also helping your clients to navigate the impact from this pandemic, as well as all the packages provided by the federal and state governments. So thanks very much for joining us, and hopefully your families are all well. Certainly a time to keep calm, carry on and look after those around us. This is truly an unprecedented event for all of us, and we're absolutely in uncharted waters. However, pretty much everyone is affected, and collaboration will be the key to successfully managing through to the other side. Many of you will have visited our Insights page on COVID-19, but we felt this was a great way to bring key issues together and give you all an opportunity to throw some questions our way. Today's agenda should be coming up on your screen at any moment. And we've got an esteemed panel here of Todd, who's partner restructuring and risk advisory, Peter Benbrick, who many of you have met, partner tax consulting, and Nick Noonan, director of Henry William Lawyers. So some of the key issues being covered today will include steps that can be taken to assess your financial position and limit the damage from catastrophic declines in revenue, taking advantage of the government stimulus and support packages, managing employee outcomes under lockdown and deteriorating revenues, and interaction with the JobKeeper payment system. And finally, accessing government-backed emergency funding and negotiating more favourable terms and payment holidays with your banks. So without further ado, I'll hand over to Todd.
Afternoon all. It's definitely a unique scenario. I think one of the best things I've seen for the accountants to have an equivalent is that the comparison is with the GFC, and people think that it's similar. But if you look at the GFC was a liquidity crisis, where COVID is a cash flow crisis. So in the GFC, if you fixed your balance sheet, your problem was solved. The problem this time is that this is about revenue and cash flow, and nobody knows how long it's going to go for. So that's why the pressure is different, and that's why the outcomes are so uncertain. So in terms of that, we've worked through a process with a number of clients, and we're having calls on a daily, hourly basis, trying to work through each of their issues. The base suggestion that we have is that you need to build a plan. All of the stimulus and all of those other things you can do are all fantastic, but you need to understand where you're trying to get to, and you need to understand what you need to do. So the first thing is to understand where your starting position is. And at the moment, everybody is willing to do forbearance arrangements, particularly the banks and the ATO. So you can work through all of those things and get a starting position, which allows you 6 months to be able to work through, as long as you understand how they all fit. Then you need to make an assessment of what you need to go forward. Each business will be different. Some of them will be working in a hibernation scenario where they will effectively close down to a very minor sort of operations. Obviously, a lot of the pubs and clubs are doing that. And then there will be other businesses which will go through, in particularly accounting services. Lawyers will suffer more as well out of this, because some of them will not be viewed, Nick, don't stop me, viewed as essential services and not required to be paid for during this period. We, as our firm, see that as likely to happen to us. So we need to understand what our costs are to continue. We've done that process and worked through to the end of 2020. That includes looking at government assistance, and that's the further funding options you need to do. And looking at how you do that, I would always suggest that if funds are going in from a related party, that there is a consideration of how security works. Although banks have said previously no to putting in secured funds around their secured facilities, now is a time where they're willing to consider all sort of options. So you may well be able to get in there with a secured facility, which ensures and protects your investment. If you're going to make an investment in this scenario, you deserve to have a priority sort of position, particularly as you're paying third-party creditors and wages and whatever else. So look at all of those options and work through those. Then you've got some understandings of where you're going to get to. And then if you really have concerns, and we're talking to a lot of not-for-profits and a lot of listed entities around safe harbour, because although insolvent trading has been suspended, there is still a responsibility for all directors to consider their obligations. And if they do not consider their obligations properly, they could be exposed out the other side. And the other option is, the other reason why you look at Safe Harbour, because it gives you an understanding of what other options might be out there that you can't see, or you might be able to tap into networks and other things. They're all on the table. And if there is a stable business out the other side, you've got a plan, and you know who you're talking to, and you know how to monitor it. So you have a structure and a strategy. In terms of the options at the end, well, the worst case scenario is a voluntary administration and a holding docker to keep the business together. But that's only where creditors cannot be put into a structure. There's a lot of informal arrangements going on at the moment, which there was as well during the GFC, but this is working now at a smaller level, and everybody understanding a bit more that this is an issue that they all need to band together and work with. So the basic of that is, as we said, you've got to have a plan. If you have a plan, you have an understanding of how you're going to get there and leverage your different points to be able to get payments and whatever else. We're obviously looking at all of the lodgements that you need to make with the ATO to leverage our position to make sure that we get paid by all of our clients. And we have thousands of clients. So we're working across varying scenarios with each of them. And I'd also suggest that direct debit arrangements over time are a good option. If somebody can't pay you straight away, how you can actually ensure you get paid and make sure that any further work you're doing is getting paid as well. So across all of those issues, you need to protect your business as well as your clients' businesses, and understand where you're trying to get to, and understand what you need to do to be able to do that. And we've got a poll question there, because our suspicion from talking to a lot of people is some people are still stuck in the, I just hope it all works, and or the government assessment will get to me, or some people are getting proactive and looking at a real proactive plan.
Yeah, so as you say, it's the focus. A lot of the discussions that we've been having, and I'm sure you've been having with your clients, is how do we get the money? It's just been a rolling series of announcements. It actually seems like a long time ago when we were still all working back in the office, when there was the initial lot of announcements, and there were further announcements. So there's certainly a lot of, it's really quite unprecedented, and I'm sure a lot of you have looked at the detail of the specific requirements, but what we're finding is it's the practicalities, the once you get down to specific scenarios, how does this apply? At least we've got legislation. So the first one that we're going to go through, the cash flow boost, which again has been enhanced from the original version of it. Version 2.0 is certainly very handy. The $50,000 for this financial year and up to another $50,000 for the next financial year can certainly be very useful. And we're going to start to see, obviously, I think we were talking this morning actually in our office about workflow, what's coming up, and BASs. How are we going to go getting our BASs done? I think this is where we're going to see a lot of demand, perhaps to get people to get their BASs done, because that's how you're going to claim this first stage at the end of the month before you actually start to see the money or see the credit. And I guess that's the thing. It's a cash flow, but they call it a cash flow boost, but it's more a case of offsetting liabilities. So the benefit might not be seen initially, but it's something you're going to see. So in terms of practicalities, what are we seeing? Well, the 50 million turnover threshold. Again, I'm sure some of you have probably grappled with this already. Aggregated turnover is a concept you'd be familiar with in the tax law, but then how does that apply to some of your client groups? I was speaking to a client late last week, a very large business with an associated business that has its own management. But they're looking at, well, if we don't aggregate them, we look at them individually, we're under. But if we aggregate them, we're not on with the work that probably pushes us over. But then the concept of aggregated turnover does exclude capital gains. Now, they sold a very large asset during the year, which would mean that capital gain doesn't form part of income for the purposes of the turnover threshold. So there's all sorts of things that you have to look at in terms of how that's measured. You probably also got multinational subsidiaries. As far as best as we can understand, we would think that those the Australian business might be relatively small, but they're part of a larger global group. almost certainly aggregated turnover is going to be over 50 if the global turnover is over 50. So probably those businesses are not going to meet it either. So, but at least with that one, we have legislation. So we've been able to go through the legislation and get to the detail. We were just talking off before we started here about there's obviously a batch of legislation that's coming up in different areas, which will help us with some of these further adjustments. So, and then that probably brings me on to the next one, which is the big one that everybody's talking about the last week or so, this JobKeeper payment, $1,500 per fortnight per employee. So really, I mean, that is a massive spend for the federal government, and it is going to have a big impact. But you know, we're not seeing that yet because the payments haven't come through yet. I think what we've seen so far is businesses register their interest. Certainly, the question, as a lot of you have probably seen, the application is relatively brief. We know the basic criteria, but then, you know, again, getting down to detail, and when you get when you actually start to, how are they going to test this? What data is the actually going to use? That's where some of the practical questions is going to arise. The other area that we've seen is certainly sole trader businesses or businesses using companies and trusts. There was nothing in it for them, for their employees, yes, but not for the business owners under the first batch of concessions. At least the JobKeeper payment has an element of, I don't know, one or two of you I might have discussed these issues with. Sole trader businesses, they've at least considered them in the JobKeeper payment. So if you're a sole trader business, you can get this access, that $1,500 a fortnight, even if you don't have employees, for your own remuneration. But everything we've sort of been able to see is if you have people are operating through companies and trusts, but they're not taking salary, they're taking directors' fees, trust distributions, profit share, and they haven't been taking salaries. Everything you read suggests that they're not going to benefit at all. And I've read some comments from some people saying, well, a lot of people saying that's unfair. One or two others have said, well, that's bad luck. It's just the way it is. So it's just, but again, that's something that legislation, that seems to be the position at the moment, but legislation might change that. So I have had a couple of clients certainly suggest that this will help them keep staff on. Of course, it assumes that you meet. So I haven't mentioned, obviously, a basic requirement of this is this 30% reduction in turnover. So obviously, a very huge practical aspect is how do you measure that? Seems to be based on the activity statement cycle. So if you're a quarterly lodger, you compare quarterly periods this year and last year. If you're a monthly lodger, it's monthly periods. But again, there will be, when you get down to the fine detail, when we get the legislation, we might get a bit more clarity on that. So one of the first, and I'm sure hopefully this will generate a few questions when we get to the end. Obviously very interested in any of your practical questions on some of this. The poll question which Tanya, we were just going to launch on there was, you know, are you seeing or do you believe that many of your clients will actually keep stuff on the books as a result of this $1,500 JobKeeper payment? So I'll just move on to the next point, and then if you could just put something up there, that would be interesting to see what everybody thinks. So moving away from employees, the other one, which, as I said, it seems like a long time ago this was announced, but the instant asset write-off, which has been a very favourite tool of governments over the last, say, 4 or 5 years, that was a significant expansion. We went from 30,000 to 150,000 for the current financial year, and the turnover threshold was increased to 500 million. So suddenly a couple of my larger clients who would never have thought of as eligible for small business, medium business type concessions could use this for earth movers, tractors, things like that, assuming they're going to make that sort of capital investment anyway. And then you've got the 2021 50% deduction. But of course, that assumes businesses, as Todd alluded to, cash flow. Cash is king at the moment. So that assumes that businesses even have cash to invest, and they're going to do that to get the tax write-offs. If they're in losses, what's the point in a tax deduction? If they're not going to lodge their return for some months, they're not going to get the benefit either. So it's just, you know, but it's there for some people to be useful. New South Wales government, Gladys has certainly got in on the act as well, as a lot of the other premiers have. Payroll tax has been a big focus there. So again, it's a much hated tax, payroll tax. So for those businesses with wages under 10 million, there's the waiver for the rest of this financial year, and then deferrals. For larger businesses, there's at least some deferrals. So there's definitely payroll tax relief there, which is going to help. The most recent announcement, which is interesting, on Friday, was about these business grants of up to $10,000 for what the things that were mentioned were businesses that are particularly going to suffer: restaurants, cafes, gyms, that sort of thing, places that are probably deserted at the moment, with limits, and one of the key limits being that they're businesses that are under the payroll tax threshold. So payroll tax cuts no use to them if they're already if they're under that size, but these $10,000 grants could certainly help some of your clients. So that's something that's definitely going to be worth looking at. Finally, on the ATO, just this is all more administrative concessions as opposed to legislation. They've certainly talked about, there's not a lot of information on this, but the announcements about varying quarterly instalments. If you're anything like us, you've just been inundated with a whole lot of quarterly instalment notices for clients. So if people know that they're going to vary, income's going to be down, now's the chance to vary. The normal penalties, to the extent that they may apply, the ATO seems to be basically saying, you vary your instalments, we're not quarterly instalments, we're not going to penalise you. So that's about as much guidance as we've got, but that should help, I think. And finally, just more generally, payment and lodgement deferrals. So there's been a lot of push from professional bodies and others for blanket deferrals, as some other countries might have issued. The ATO keeps pushing back on that and saying that, we're not going to issue blanket deferrals, but talk to us. So there's definitely a lot of leniency around payment. I think they'd like lodgement, but if they can't get lodgement, then they're certainly going to be lenient around lodgement deferrals as well. So I think we'd like clients to send information in to keep our staff busy, but obviously from your client's point of view, getting their tax returns done might not be their priority. Getting their BASs done might be, because then they can get some of their concessions. FPT returns might not be a high priority. So again, if you're going to have difficulty getting some of that work done, talk to the ATO. That's probably the main message there. So,
Thank you, Tony. I only thought this morning how quickly the world has changed. We had an HLB function the first week of the NRL season down at Cronulla, and we definitely weren't observing social distancing then, but I do remember we were talking about some of the early stimulus packages, and so much has changed since then. The world seems like a very different place, including not being able to watch NRL, which hurts a lot of us. I'm going to speak for 10 or 15 minutes about a couple of issues. One is standing down staff. The other is alternatives to stand down. And then I'm going to talk briefly about the JobKeeper payment and the relationship between JobKeeper and some of these alternative employee arrangements. The big caveat is one that has already been foreshadowed, which is that the legislation for JobKeeper has not yet been enacted. I heard Christian Porter, the IR Minister, on the radio this morning. They've committed to getting this through on Wednesday, but some of the issues that have been played out between some of the union groups and the government in the past few days suggests that there's still some controversial issues in the legislation. So I guess we'll have to see how that pans out. So that's really the caveat in respect of JobKeeper. But starting with stand down, there's been a lot of government rhetoric using the word stand down, and even the JobKeeper fact sheets refer to employees who have been stood down. And I think for that reason, I've been talking about it with clients for the past probably 2 or 3 weeks ad nauseum, but there are some important subtle distinctions between stand down and some other alternative arrangements that might lower legal risks. I will also have a short condensed version of some slides that I can distribute after this presentation, so I don't feel like you need to make a lot of notes if that's what you're doing. So just on stand down to start with, stand down is a very special power that lives in the Fair Work Act, and prior to this month, I don't think I ever talked to clients about it. It's become extremely popular extremely quickly because it gives an employer in confined circumstances a basis to stand down employees and not pay them, which means they remain employed, but they are not paid. Now, the situation with stand down is that it is very confined, which is why I've been cautious with clients. And if you look at the Fair Work Ombudsman and its own guidance, it has materially changed also in the past month as some of these government directives have become a bit more extreme. So although the Ombudsman's initial guidance was almost suggesting not to use it because it wasn't available, that has now changed with some of these new government directives which prohibit certain businesses from operating, but also prohibit Australians in the way in which they go about their daily lives. So starting just with the legislative provision, it's 524 of the Fair Work Act, but essentially the situation is this: an employer can stand down an employee during a period, and there's a couple of key concepts here. Firstly is the period is one where the employee cannot usefully be employed, and it has to be because of a stoppage of work for any cause for which the employer cannot reasonably be held responsible. So if you combine those concepts, you need to have employees that can't usefully be employed, so can't be doing other things, and it has to be a stoppage of work, not temporary, and it must be for some third-party cause. It's not a cause for which the employer is responsible. Now, traditionally, that sort of clause was relied upon for things like natural disasters or inclement weather. It's that rare, and it really depends on the actual factual circumstances. Some other significant consequences of a stand down: firstly, it does not count, it counts as service if an employee is stood down, which means while employees are on a period of stand down, they will continue to accrue paid leave entitlements. And that's compared with one of the alternative arrangements that I'm going to come to. So just looking at where a stand down might be appropriate given the current circumstances. And I said the Ombudsman started off being very cautious, and now they're sort of tacitly endorsing it for some circumstances. But if you had a business which was prohibited from operating, so take a restaurant or a bar or a gym or a pool, there's absolutely no doubt that if you could not usefully employ your staff elsewhere, such as working from home or working from another location, you would have an absolute basis to stand them down under that section of the Act. But compare that to, and the Ombudsman has continuously used this example, that they say that generally deteriorating business conditions will not normally give rise to a stand down. There needs to be some third-party cause for which the employer is not reasonably responsible. So if I take two examples, and I've had these come up with respect to different clients. So I use the first one of a restaurant that has been shut down other than for takeaway. So some of their staff are not stood down because they can usefully be employed performing the takeaway functions, but the rest of their staff can lawfully be stood down. With a retail shop, there's an argument to be made, I think, with retail stores, some of them, that because of the government directives to Australians that you should be at home unless you are shopping for essentials, there's an argument that your clients disappear if you're running a clothing store. In saying that, a lot of those clients are taking a more cautious approach, which I'll come to, as opposed to stand down. And the reason for that is what I expect to see, probably not immediately, but in the next couple of months when things normalise, knowing also that some of these staff that are stood down will become entitled to JobKeeper. I think there will be some claims made, particularly by staff that have been stood down and possibly made redundant at some stage in the future, to try and challenge the validity and the legality of the original stand down. Because unless you fit within those confined circumstances, there is an argument that it's invalid, and the consequence of that is the employee should be paid for the period. So I'm expecting a lot of those claims simply because employers are acting in very difficult and stressed circumstances. As I said, the government language seems to be a lot about the stand down, but there is very subtle distinction between a stand down and, say, taking leave without pay. So let me just come to some of the alternatives to stand down just to play that out. The reason for alternatives really is to lower the legal risk. Because stand down is a direction and it only applies in very confined circumstances, there are other options that certainly my clients are looking at and which definitely lower legal risk. So firstly, an agreement with your staff to take leave without pay or unpaid leave is not a stand down. And if employees are agreeing to it, there's no basis that they could argue that it's an unlawful stand down. The other, advantage of leave without pay is that the Fair Work Act makes it very clear that any leave without pay period does not count as service, which means that leave does not continue to accrue during that period compared to the stand down. And I also think that as far as some of the government benefits, including JobKeeper, are concerned, and again, the caveat is we haven't seen the legislation, I don't think the government with their stimulus package will distinguish between employees who are stood down and employees who are taking leave without pay because of COVID-19. I think as far as eligibility goes, which I'll come to for JobKeeper, all they want to establish is that someone was an employee and they are still employed for eligibility to apply. And some of the other things that I've seen my clients certainly doing is, in addition to requesting employees to take leave without pay and having them sign off on it, is to ask employees or agree with employees to access their annual or long service leave entitlements. One, hidden risk there is a lot of the modern awards and industrial instruments impose limitations on when an employer can direct employees to take annual leave. Usually they're confined to situations like where employees have an excessive leave balance, or if the business is doing an annual shutdown, like a Christmas shutdown. So for that reason, to sort of circumvent that issue of a direction to take leave, it's really an invitation that the employees sign off on, and then it becomes a legally binding variation of an employment agreement. It will be interesting, and I might come to it again with JobKeeper. Once the JobKeeper payments start flowing, like I know, for example, a lot of businesses have directed people to take leave. There'll be a question then for employees as to whether they want to go back to their organisation and say, I don't want to be using and running down my leave balance. I'd prefer to go back on or to go directly onto the JobKeeper and receive the $1,500, but we'll see how that's played out. With long service leave, that's also an option. The government urgently amended the Long Service Leave Act in New South Wales, they're all state-based laws, to allow some flexibility, essentially to allow employers and employees to agree that the employee can take leave and to waive some of these normal notice requirements. Another option, if we're talking about alternatives to stand down, would be agreements with employees to reduce either days of work or remuneration. I've had a lot of clients interested and affecting these types of changes. Again, because remuneration is a fundamental term of employment, any attempt to change it needs to be agreed. So these organisations essentially, as an alternative to redundancy, are saying to staff, we invite you to accept a pay cut for a defined period, and please agree by signing this letter. The other thing that a lot of organisations are doing in that circumstance, and this is an absolute ex gratia benefit, would be to do something like guarantee, if an employee is made redundant during the period when they're on a pay cut, that their termination entitlements and leave accruals would be paid out on termination at the old higher rate, just to give them some form of comfort. Reduction in hours and days is the same. Again, it can be done provided that there is agreement. If there's not agreement and an attempt to force it, that's problematic. A lot of the underlying modern awards and industrial instruments will impose consultation obligations if there's any attempt to or contemplation of reduction in days, but by agreement is absolutely fine. The other thing I'll say about reducing remuneration is, remember, these awards will often include minimum rates of pay based on what the employees do in their corresponding classification in the award. So any reduction in pay needs to be to a point which is above the relevant minimum wage for that employee's classification and not below it. I might just move on. I'll mention redundancy briefly. You know, the reason why a lot of these alternative arrangements, as far as I've seen in the last month, have been successful with clients is because the alternative is redundancy, you know, losing one's job. The Fair Work Act includes a redundancy pay entitlement, which is based on service, starting at 4 weeks pay at 1 year and up to 12 weeks pay at 10 years service. There are some exemptions to that are built into the legislation, including for small business employers. So if you've got less than 15 employees and don't have employees in related companies, then you might be deemed a small business employer, which means you're exempt from redundancy pay. The only base upon which an employer cannot pay redundancy pay to someone who is otherwise eligible is you actually have to make an application to the Fair Work Commission to apply to reduce that amount if you cannot pay the amount. So it's really meant to address employers in insolvency situations, but otherwise you're up for the redundancy payment. Just finishing with some comments on JobKeeper. Obviously we're expecting legislation on Wednesday, but there is a lot of confusion in the market about eligibility. I think the easiest way to look at it is, are you an eligible employer? Who are your eligible employees and what you need to pay? So starting with eligible employers, they are businesses with that relevant turnover reduction. So for businesses with turnovers of less than $1 billion, they're talking about a 30% turnover reduction in a corresponding period last year. They haven't actually put the meat on the bones as to what period they will take into account. They're talking about at least a month, but it might be up to 3 months. Businesses over 1 billion, they need a 50%. And today they came out, 50% reduction. And today they came out and made a special exemption around charities and not-for-profits where you only need a 15% reduction. So once you satisfy that turnover criteria, you become an eligible employer, and then you become eligible to receive this $1,500 per fortnight for 6 months for all of your eligible employees. So eligible employees are employees as at the 1st of March this year, and they would be full-time, part-time, casuals who are long-term casuals. Now that's contentious also in the legislation. There's a bit of chat about that in the past couple of days, but at the moment I understand it to be like the definition of long-term casual in the Act, which is someone that's been with you for at least 12 months as at the 1st of March, and a regular and systematic, but that might change. So that's your list of eligible employees. It would include employees who are made redundant after the 1st of March and then rehired. I don't think that's going to be many. And say about that is I've certainly seen in the past month a lot of organisations who have used, even though they might be suffering some financial issues as a result of COVID-19, a lot of organisations are using COVID-19 as an opportunity to restructure, to create the business model at the end of this that they probably wanted to have anyway. So I think to the extent people are made redundant, certainly based on what I've seen, I think it will be unlikely there'll be a lot of rehires just so that they can qualify for JobKeeper, but it remains. Once you've got eligible employers and eligible employees, essentially from May, the ATO will make payment for all of your eligible employees backdated to the 30th of March. So the government at the moment is saying, please start paying it now if you think that you are eligible. I haven't seen any organisations take that up. I think most organisations will be cautious, wait to see what. Obviously, the ATO registrations are happening. Businesses are jumping on to seek eligibility, but until such time as, one, you get confirmation that you're eligible, and two, the businesses are actually seeing money from the ATO in their bank accounts, I don't really think people will be prepaying this stuff, and there's certainly no obligation to do that. But once the payments hit, they will be backdated to 30 March and $1,500 per fortnight for each eligible employee. Now, the last piece of the puzzle is how you actually pay your staff. So this is a subsidy paid to employers. It's not paid to employees. So if you've got an employee that is currently receiving more than $1,500 per fortnight, they will see no change to their pay packet, but the organisation will receive that $1,500 from the ATO essentially as a subsidy. If you've got an employee who is receiving less than $1,500, the employer will have to top them up to $1,500. So that might benefit, perhaps unintentionally, some individuals that were currently earning that much, and that had nothing to do with COVID-19. So you had a casual employee that was working 1 day a week. Those people will be bumped up to $1,500, subsidised by the government. And if you've got an employee who is stood down or not being paid, and I think that's going to cover your unpaid leave category of staff, then you would receive $1,500 of an organisation and have to pass on the full $1,500 to them. Some things that aren't really that clear to me, and some issues. Some of those circumstances I've described, like employees who have recently had their hours or their pay reduced, will there be any obligation to top them back up to the pre-reduction pay? Don't know. I also think this issue of employees that have been directed to take annual leave, like I've got clients that have required people to take annual leave. I expect you'll see a lot of employees that will say, I want my leave balance preserved. I would prefer just to receive the JobKeeper payment. So I guess it's a watch these space for a lot of these issues until Wednesday or later in the week. That's all I've got to say for now. Thank you.
Actually, sorry, Nick, can I just jump in there for a second on the point you just mentioned about the amount that you're paying that the employer's got to pass on to the staff member. So, as you say, a lot of detail still to be seen, but our understanding is that the $1,500, it's obviously replacement of income for so it's got to be taxed. So,
Correct.
so the employee is going to see their net pay like they normally would. So.
Yeah.
So for someone who's less, and I don't know how many there'll actually be in this category, but for those people who are going to get those employees who are actually going to get a top up because they're not earning that much, they won't get $1,500, but they'll get $1,500 less tax. The tax might not be much, but there'll still be tax taken out for what it's worth.
That's right. The effect is that every eligible employee will receive at least $1,500 per fortnight less tax.
Yeah. And Nick, in a scenario or a sort of economy where we've just gone through all of these issues about people calculating entitlements correctly and paying people correctly, and some being caught paying 100 million short, surely this is going to add to the complexity around all of that, and people are going to spend more time fiddling around with all of these things. Yeah,
absolutely. And today, listening to the radio, and Christian Porter was struggling to answer a few questions that I thought seemed reasonably simple. So I think there will be a good drafting exercise that's going on. I think they will need to probably, and this is why he's talking about amending the Fair Work Act. I think it's to address some of those issues that you're talking about, Todd, like to give greater flexibility during this 6-month period to employers to do things that they're otherwise not currently permitted to do under the Act. I think they'll have to amend the stand-down provisions that I talked about at the opening, which currently provide that if you're stood down, you are not entitled to payment, which is wrong if you're getting a JobKeeper. And I think they will probably amend it to also make it clear that an employee who is stood down by virtue of COVID, that stand-down period does count as service for the purpose of leave accruals. There is a lot of ambiguity, and I think that's why I'm seeing, at least with my clients, they're not really changing their current arrangements at the moment. So take the last month, the phone's been ringing. A lot of people are saying, what can I do to preserve my costs? Can I reduce days? Can I reduce hours? People that have done that, I don't think they're going to change anything until at least May, when they see some money in their bank account. And then you might see perhaps some renegotiation. So a lot of these contractual variations, people dropping pay, organisations might then say, well, they'll have staff saying to them, can I go back to now that you're getting $1,500, can I go back to my pre-variation pay? So to the extent that people have already made some of these changes and may not have properly documented them, I think there's going to be some disputes.
So maintain your HR staff for as long as you can, because you're going to need them to help your way through this. And you need a good lawyer as well, obviously.
Thank you, Tony. Thank you, everyone. So to Todd's point at the beginning, the banks are offering these unprecedented loans to SMEs to really assist with cash flow through this next period. So they are government backed, and the government is guaranteeing 50% of the loan, and the banks are taking a risk on the other 50%. These loans are not being processed through traditional rigorous credit assessment, and in some instances the bank has actually already made the funding available to SMEs via their email communication channels. If a loan amount is greater than $250,000, the banks are open to discussion on repayment deferrals for business debt. The HLB Debt Advisory Team, we're here, we're open to facilitate those discussions for your clients with the banks. I'm just going to talk through the bank's relief packages for SMEs and for residential customers. So for SMEs, we've got government-backed funding for SMEs. We've got the business loans and the equipment finance loans of up to $250,000. We've got no repayments required for the first 6 months. We've got loan terms up to 3 years, and principal and interest repayments will apply only after an initial repayment holiday. So these loans are really unprecedented loans. You don't see loans like this come out in my 20 years of banking. So yeah, there's no establishment fees on these loans. Interest rates are really low. There's no loan service fees. The loans will be available up to the 30th of September. They are open to new and existing customers. Existing customers that have got overdrafts or current business loans, they're offering reductions on overdrafts of 2% and on small business loans of 1%. There's no merchant terminal fees as well for those businesses that do operate their business over the merchant. These are being waived for 3 months. So as you can see, it's really providing cash flow solutions for businesses and sort of deferring all of these expenses for the next 3 to 6 months. I'll now talk to the residential side of the bank's offering. So for personal customers, and obviously for business customers that have got personal debt, banks are offering a 3-month deferral up to 6 months after a 3-month review. So on a loan size of, a typical loan size of $400,000, it is an annual saving of around $11,000, sorry, a 6-month saving of around $11,000 for the 6-month period. So residential customers are also being given access to term deposits of 1.75% for 10-month terms, which is pretty high for today's rates. And they've also reduced, the majors have also reduced their fixed rate products. And some banks are offering 2.09% for a fixed rate loan for 2 years on an owner occupied loan. So yeah, so it really is, to Todd's point, around just allowing some pressure off the cash flow for residentials and for business customers. And it's open to new and existing customers as well.
Betty, can I ask a question?
Sure.
What's the anecdotal feedback on how the banks are handling what would be a tsunami, I would have thought, of applications and requests to defer, to get cheaper funding or whatever it might be? How are they handling what inevitably will be a huge workload?
It is a tsunami. How are they handling it? So I can't speak for the banks, but I do know that they are absolutely being overwhelmed. Some of the banks, CBA, for example, have actually, they've gone and issued an email to all of their business customers and said, if you want access to this $250,000 loan, then, you know, this is the process that you need to go ahead to apply for it. So how they said that you're just going to have to be patient, I think, but they definitely are. Everyone is eligible, and it is, and we're happy as with the debt, James and I and the debt advisory team are absolutely happy to facilitate those discussions with banks. We've got some connections in the business and corporate segment that we're happy to pull on if we need to. So yeah, I'd say it's definitely an overwhelming and stressful time, no doubt.
Thanks. Any questions from the other panelists? If not, we have. It looks like we have one Q&A question, and that's probably because the presentations were so incredibly riveting that nobody actually found time to type anything out. But while where Nick is answering this question, maybe the audience can think of some more questions I'd like to throw at the panel. Nick, I think this one's for you. The question goes, for JobKeeper employer eligibility, does the employee need to be a resident/citizen, irrespective of whether she is a full-time or part-timer?
No. As far as the information that's been released to date, eligibility is both for Australian citizens or if you're the holder of a permanent visa, a protected special category visa, a non-protected special category visa holder who has been residing continually in Australia for 10 years or more, or a special category, subclass 444, which is like, I think, the old 457, visa holder. So not only Australian citizens can be certain prescribed visa holders.
Okay. All right, and we've got another question that's just come in. One from Daniel Hobbs, JobKeeper. I don't know whether that's the question or a statement.
I don't know either, but yeah.
So Daniel, you might, he's still typing, sorry. Okay, Bernie Gore has asked, for lumpy cash flow businesses, re JobKeeper, do you expect that the entitlement to $1,500 per employee be recalculated each quarter or each month? That's probably back to you again, Nick.
Yeah, I think it is. And I'm not sure if the intention of the question is to address a business that does satisfy the eligibility criteria. So is at the time of making the application down 30% turnover, but may in the future over that 6-month period possibly not fit that exemption. But certainly the intention is once you are eligible and the ATO ticks off on your eligible employee list, which is a list of people that were employees on the 1st of March and are still employees, then you as a business get that $1,500 per fortnight for every one of those employees. And there's no intention to change it or recalculate it. The only issue might be around, and this hasn't been clarified yet, what is the test for employer eligibility? They're talking about exemptions for businesses that were not around a year ago, but have still suffered a significant turnover drop since they've been incorporated. So once you satisfy eligibility, I don't think there's any intention to change the ATO payment to the business for each eligible employee.
And I think Nick, and that probably goes to this question that Michael has put up, Tony, eligibility. That as Nick says, it's a question of, and this is where we will be looking for the legislation. But I think that's one of the practical issues that we're seeing. As to what a lot of businesses I think are not seeing that drop off yet, but they will soon. And that's where so the eligibility will kick in.
Yeah, and
I guess goes back to Nick's point. Then so eligibility kicks in, and then but there's the mechanics around how you measure it is sort of part of what we're waiting on.
Yeah.
And
do you have to have been trading for 12 months prior? Full 12
months? As Nick was alluding to, there's an indication in what's been released so far that there'll be a recognition that businesses that have were not established. There's discretion. The Commission will be given quite a bit of discretion to so that's the way I read it. I mean, because it's Commission's discretion, so that you'll have to show that you've been impacted where you wouldn't otherwise meet the test.
The ATO will be dealing with a lot of applications, and they're under pressure to meet their promises. So, although the ATO is usually a very stringent authority, I think they will be more flexible about these applications than at any other time in history.
Yeah, and it'll have to be the process. I mean, I think the process will be interesting as to how the application is gone about, because this won't be. It's not so much in the Tax Act as self-assessment, and you've got the Commissioner has discretion, so you apply for discretion. I mean, that all takes too long for this sort of thing. So it's going to have to be much speedier, and probably again that's part of the application process. I would think that
and this whole idea of turnover, Pete, it's really unclear what it actually means.
Well, that's right, and in fact measurement, yeah, that's right, and this isn't quite. This one doesn't appear to be defined in quite the same way as the turnover for the cash flow boost. So it could be a different definition of turnover. So we're going to have to. We're really hanging out for that legislation to then.
Yeah, because there's a massive timing difference about on cash flow basis of when you might actually bill something and when you actually get paid it. And the ideology here is to try and keep cash flow going. But if you make people who are ineligible who turnover hasn't changed but might not be actually able to collect anything and are still keeping employed, well, that would appear to go against what they're trying to do.
It would, but of course we always say that, you know, tax law and tax law doesn't always give you the logical outcome. But yes, of course they're going to have to try and get this to match the policy as best as possible.
So
All
just
right. Well, in the interest of time, we'll keep moving because we're getting a number of questions flowing through here. A question here again for you, Nick. I think if someone is on stand down, does their service continue to accrue for long service calculation and future redundancy?
so I can answer that easily. If it's a stand down under the Fair Work Act, which is those confined circumstances, it definitely counts as service for other entitlements. Whereas if it's unpaid leave agreed, or leave without pay agreed and not stand down, it does not count as service for those entitlements. Just looking at some of the other questions, I can see them in this box, and there's a couple that I can probably answer quickly. Peter, I might come back to you on the mum and dad businesses and directors' fees, which...
Yeah, I'll make a comment on that, but do you want to keep going?
Yeah, so JobKeeper eligibility, Michael's question, many won't experience a drop in income immediately, but will from April on. Again, they haven't defined this turnover eligibility. I expect that it will not have to have already occurred in March based on what I've read. They just haven't defined that yet, but I think that would be silly that they'd put a line in the sand and say it had to have been at March. It's meant to affect businesses over the next 6 months that will... So I think it will be...
No, I think, well, my reading of that is definitely that businesses that will... I've spoken to several clients who are going to experience that drop in May, June, July. So our expectation is that they'll be able to claim something.
Yeah, great. And on Daniel's question, that's a good one. And this is one of the issues that I think will result in some disputes. So the question is, assuming an eligible employer, say all staff go to 3 days a week and were on 100K, now all on 60K, can staff still be paid 60K and employer get the, I think that's meant to be 1,500 a fortnight, or do staff need to go back up to 100K? My reading based on the fact sheet that come out to date is that they stay on whatever they've agreed to stay on, 60K. You continue to pay them 60K. If that 60K means that they're earning more than $1,500 a fortnight, then you wouldn't have to change anything. If the 60K means that they're currently earning less than $1,500 a fortnight, you just have to top it up to $1,500. But there's nothing that I've read that suggests that because of JobKeeper, you need to renegotiate back to, or employees are entitled to go back to 100K. And I think that's a really good question and a big issue, because certainly in my experience in the past few weeks, a lot of organisations have agreed with their staff to take pay cuts, but it was all pre-JobKeeper. So a lot of these employees will now say, well, can I go back to my 100K? So how it has been documented, if it's been documented is why, it's a typical lawyer thing to say, but if you're varying contractual terms, make sure you get some agreement in writing.
So Nick, 1,500 a fortnight is around 39 grand. So everybody over that, it'll just be. But the brutal reality in that scenario is those people are all keeping their jobs because they've taken the cut, right? And the bank, and the government backstopping it is probably helping that process.
Agreed. I don't think the government will go into individual workplace negotiation. I just don't think they'll go that far, because there'll be so many ancillary agreements that,
but in that scenario, it means that the owner needs to fund 20 grand a year for each employee, that being the difference over the top, which means that they might be willing to do that to be able to make it work.
Possibly, yep.
Well, they might keep more people on, yes, instead of cutting a couple of people.
They might re-engage some of those people that they've stood down, or
Yeah.
Well, they might have been thinking about cutting a couple, and now they won't.
Yeah. And I had a conversation with a client this morning, and that was the situation. I was going to stand this person down, or I was going to make this person redundant, but I won't need to now if this comes in.
Yeah. Peter,
So
there's
Tony, I think David Simmons' question is worth
that's exactly
getting to.
right.
Yeah.
Mm.
So David, your question is a very good one. I think I alluded to that briefly, but the mum and dad businesses who only take directors' fees, so you're talking about an incorporated business, same would apply if it's in a trust. So there is no, I mean, the $1,500 thing, there is JobKeeper, there is no relief for that. There's clearly relief, as I said, for the sole trader. I mean, again, we'll be interested to see if there's anything in the legislation that covers that, but certainly got, actually, if they've been, sorry, to more directly address that, if they're taking directors' fees and they already have been, then I would have thought that is, particularly if they're at a level where they're deducting withholding, then again, Nick, if you've got any comment on this, I would have thought definitely they're deducting POG withholding, they're on a payroll. I would have thought they qualify just as much as other employees.
Oh, yeah, I think that would be the intention.
And I've got one client, a couple of guys started up a business. They don't have any other employees, but they have taken the last 2 years, they have taken some directors' fees, one a bit more than the other. But they'll obviously even that out through dividends or whatever they do, they'll sort it out amongst themselves. But they've each taken enough, and just because we're not paying them regularly, the fact that they're on the payroll and they've taken salary in previous years, to me that would be enough for them to take salary now or take directors' fees now and be able to get something, both the cash flow boost and the JobKeeper, I would have thought. But if you're not taking, I think the other side of David's question is if they haven't taken directors' fees previously, or if they're in trusts and they haven't taken any salary and they're just getting dividends or trust distributions, then they could be stuck. I mean, that's our best reading of it at this stage.
So, Nick, did you address Michael's question on when the drop in revenue occurs?
Yeah, I did by saying that there's not enough in the material that's come out to date to answer that. They certainly haven't said that they're going to draw a line in the sand. They've suggested that they will be flexible about the turnover drop, and I think they linked it to the usual BAS statement period. Perhaps
Correct. Yeah.
It might be a 3-month comparison to a comparative period last year. If it's normally on a 1 month, it'll be 1 month. But they haven't necessarily said it needs to be in this year a period from, say, the 1st of January to the 1st of September. They just haven't that detail yet.
Okay. Another one from David. Is cash flow package benefit affected by existing tax debt? Peter?
I'm not exactly sure what you mean by that, David. Do you mean we're going to have to pay for this somehow? Is that what you, so is that,
Yeah, David, you may have to just
or the
that.
clients? Okay, or do you mean the existing tax debt that a taxpayer has? Do you mind just making a comment about that, David, just to clarify the question?
While David's doing that, we might flip to another question from Michael. Nick, this is again for you. You're in popular demand here. Could you please talk briefly to your opinions on employers adjusting wages to artificially access or increase their entitlement for JobKeeper? I note the talk around scheme to do so and potential penalties, but how could that be policed?
Yeah, look, I certainly haven't seen it, but if you focus just on the black and white of the eligibility criteria at the moment, your business will be eligible in respect of every employee who was your employee on the 1st of March. So, and once you satisfy that criteria, you get your $1,500 for each of those people. Doesn't really matter what they're earning. What they're earning only affects whether or not you've got to pass on all of it or any part of it. I think it would be difficult. Well, where the malice might be is for some employers that want to artificially suggest that someone was an employee on the 1st of March and is still an employee, which may be difficult. But otherwise, with respect to adjusting wages, look,
perhaps I'd suggest, Nick, that the turnover measurement might be where the mischief might come in.
Yeah, absolutely.
And look, what we can say is that there was a specific provision put in the legislation for the cash flow boost around anti-avoidance and schemes. So that's there. So, and that was particularly where oh, look, same there, but certainly that one's going to would apply automatically by the ATO, but the ATO has the power to look for a scheme and then deny that benefit. So it wouldn't be difficult to put an anti-avoidance provision in there. The question is a good one. How do you police it? But perhaps definitely the turnover would be something they would have a look at. And then
one thing that just came to mind then is there might be an attraction to, I know that actually wouldn't work. I was going to suggest, mate, standing down more staff so you're not paying them. But if you're doing that, you're still required to pass on that whole $1,500. So I don't really think there's an incentive to do that. I think
that's right. Less incentive to do that than to probably do the cash flow boost. You actually are getting perhaps a more direct benefit.
And I think the ATO, having dealt with the ATO enforcement areas, the ATO's database now it'll be very aware of where money's going to and who are the people they need to monitor more so.
Yep.
And all of that will be interlinked here to be able to make sure if there is anybody who manipulates the system, they might get the short-term gain, but I think there will be a deliberate effort to make sure that anybody who has gamed the system will be reckoned with afterwards.
Yeah, and there could be, and like when you're looking at turnover, there could be something around, if I know there's practical issues that we've got around where clients, if there's groups of related entities and the turnover partly comes from, there's a question of grouping too, perhaps, but if the turnover partly comes from transactions between related entities, certainly if people start manipulating those, then again they could come to the ATO's attention.
Okay. There was a follow-up question. David sent through the follow-up to his previous questions. Would $10,000 be offset against integrated client account balance? Peter, sounds like it's up your alley.
Okay, so if you're talking about, the cash, so the cash flow boost, sorry, Michael's made a comment about the cash flow boost. Yeah, so we're just talking about that. On David's question, yes, the method of, now I assume that David means the cash flow boost being the minimum of 10,000, the maximum of 50. So the mechanism there, which we do know, is that'll get delivered by crediting to their ATO account, integrated account, as David implies there. So the idea would be that they should be lodging their BAS, paying the GST, paying the FBT, whatever else. If there's a not pay the PAYG if it's no more than the 50. Say if their PAYG is around 10,000 or less, don't pay that, and they'll get the 10,000 credit to their account. And the ATO has said that if there's a credit ultimately to the account, that should be issued. You shouldn't have to apply for the request a refund, as is often the case. You should get that issued automatically but they have got 14 days to actually get the refund out to the taxpayer. So that's how, hopefully that answers the question. That should happen. And if people overpay because they pay their PAYG as normal, then they'll get a refund. With Michael's comment, I think we've addressed Michael's comment on the PAYG withholding. That is that there is anti-avoidance there, if that answers the question.
We've probably got time for one more, and Paul sent through a question. If a director is usually paid, say, 80K per annum and has not been paid in the first 2 quarters of 2020, could we pay catch up in Q3 and Q4 and take advantage of stimulus?
Well, I think Paul, you're right. If again, it's subject to any comments Nick has. If we're looking at the cash flow boost, certainly you can look at what they're actually being paid what the actual withholding is in the March quarter. So assuming they're quarterly or the March monthly. So certainly if you're talking about a director and there's control over what's paid, then yes, I would be looking at that. I don't think that's an anti-avoidance scheme. I think that's just if it's a sort of an owner and managed business and the amounts vary because it's effectively a distribution of profit. So then I don't necessarily see a problem with that. I don't know, Nick, for the Probably for the $1,500, it doesn't really have much, probably doesn't have a huge impact.
My only comment on that is all the material that's been released today talk about self-employed persons having an eligibility, but they haven't distinguished between those that might be incorporated and those that might be as an AIM holder. So I guess the threshold question is, will they make some distinctions or exempt, for example, anyone that's incorporated?
Well, I think in JobKeeper, there doesn't appear to be anything about that. But with cash flow boost, you know, it looks at the PAYG withholding. So the way I'd see that is if you've got directors' fees coming through the payroll, that's going to be in the PAYG withholding number. So if that's partly what Paul's getting at, then I think there would be an opportunities there.
All right, folks. Well, look, I think in the interest of time and knowing that everybody's got a heck of a lot of work to do out there just to tackle all of these issues, we might call it a day. Please tell us how you'd like to keep in contact. We're here, we're accessible. You've got all our contact details. This webinar will be up on our website, which you can access at any time. Feel free to reach out to us. We're here to help. We're here to collaborate, so please don't hesitate. Thank you one and all for attending, and thank you very much for the questions that you put to us.